I think everyone's coming in now, so that's good. Just like to welcome everybody to another week of Learn It Live. I've been really enjoying doing these sessions with everybody and getting some great feedback, so thank you very much. My name's Thomas Atkinson, and I'm here with Tyrone as always.
Hi everyone and welcome. You'll find tonight really entertaining. Risk management is a lot of fun, even though it may not sound it.
Yeah, we've got some great programs actually that can help us, and I think a lot of people, we hear it all the time, people struggle with risk management. Not only from the psychological kind of aspect, but also just from having to use the tools and how to work out the right contract size that's right for their account. So we're going to go through a couple of different strategies tonight and use a few different tools, and we'll get started now. So as always, I'd just like to start with a risk warning. I'll let you guys read this. I'll just start off with the first bit. Obviously, the information provided here has been provided by third parties and does not reflect the opinion of Pepperstone. The information has been provided without any alteration or verification. Just let that run off for a couple of seconds. So what we're going to be covering today, we're going to use a few different tools, as I said before. So we're going to use the historic price fluctuation to place stop losses and take profits using AutoChartist's Volatility Analysis. So a lot of people may not be familiar with this tool, but it's actually really good to use, and it's an interesting take on where to place stop losses if we don't have any idea or we want to use statistics, I guess, to our advantage. So we'll start off with that with some fixed risks. Then we'll use like a market structure technique, so a technical analysis technique approach, and we'll use the Pepperstone smarter trading tools. And then we'll go through and use like an averaging of in and out of positions using, again, the mini trade terminal, but this time using smart lines. And I think a lot of people have probably never used smart lines, and it's a great way of scaling in and out of trades at certain points. And of course, we'll do this all with live examples in the market right now. So we'll actually place some of these trades so you guys can see how much risk we're placing in each trade. So I think the question that always comes up is that you need to risk the right amount for your account. Now, it can be different for a lot of people. Everybody always says risk between, of course, 1 to 2% of your account balance per trade, but it really is up to you how much you feel like risking. A lot of people don't realize, though, in Forex, you can trade a very small amount of money to get started. And both Tyrone and I actually recommend that the way that you trade in your account, at least at the beginning, is rather than even using a demo account, we recommend you have a smaller account and then trade small amounts of money. So you can actually risk with a lot of these tools. We call it the cup of coffee and muffin approach. So something like $5 or something you could risk per trade. And that's amazing because you can't do that in many other trading markets.
We do find it's actually amazing how many people start out with good intentions in a demo account and think that they're going to apply the right risk management strategies. But we find that if you do actually go into a live account, even if you are trading very small, you do apply a monetary value to your trade, and you do, believe it or not, take it far more seriously, even if you are only risking $1 or $2 per trade. So we'd strongly encourage you to do that because it is the stepping stone to actually making serious money in the market.
And more importantly than that, trading is a business, and you have to approach it like a business. So if you are trading a demo account and you're trading $1 million account and you only have $1,000 that you're actually able to trade with, you're not really giving yourself a fair chance to be more realistic about your trading approach. And that's very important to your psychology as well, which we're not going to cover heavily tonight, but I think that just by starting with a small amount, $5, $3, something like that per trade, it gives the trade more reasoning and you actually take it more seriously. And what that means is that you're going to be more accountable for both your wins and losses and learn from your wins and losses. And it's very, very important to learn from every trade that you do make. Otherwise, you end up doing nothing for many years, and we do find many people come to us after 2 or 3 years and they say, I feel like I've traded a lot of time, put a lot of time into my charts, but I'm not getting anywhere. And that's partly because they're not being accountable for each trade.
It is very important that when we look at trades, even in a small account, you have to remember and be mindful that whether you're trading a $1,000 account or $1 million account, the risk needs to stay the same because the trade actually doesn't change itself for the volume that you're trading. Basically, all that changes your stop losses and your take profits will stay in the exact same place no matter what size account you're actually trading. So that's why it's vital that you start out in a live account, because then you can grow it accordingly. A lot of people have a misconception that as their account gets bigger, their stop losses get smaller or their take profits get smaller because they're making more money. But actually, that couldn't be further from the truth. The stop losses and take profits actually don't change. It's actually the amount of contracts that you're trading that does. And that's why it's really good to get good practice right from the start and practice good risk management.
As we said as well, scaling in and out of orders is going to be a great tip for you guys tonight, because that's something that I don't feel many people do or have the ability to do in MetaTrader 4 without these tools. So it allows us to actually take part of our contract and close it at different take profit levels, which is really, really good. And of course, also even scale out of our stop losses. So maybe we want to take some of the order off if a certain point is hit, and we'll go over that tonight. So let's now take a look at the AutoChartist Volatility Analysis. So it actually has a tool in it that allows you to price range forecast by a percentage, and that's a forward-looking view based, of course, on previous history. The thing that's cool about this is it takes into account the current market conditions and movements, and then it will work out based on a probability of how likely that particular currency is to move past that point in that particular 4-hour, 15-minute, 1 hour, or daily time frame. We'll have a look at the chart in a minute just so you can see it. You can also see whether the market's like a conservative market or a volatile market by these ranges. So effectively, if the market is moving maybe more from a fundamental standpoint, you are going to see bigger ranges. And if it's working more like a technical market or a conservative market, you usually see smaller ranges. So it can help us to define whether we want to be trading in the market based on whether we're a volatile market trader or more of a conservative market trader. So let's now take a look at the odd and actually place a trade together to have a look at how this tool can help us. So here we've got the Australian dollar, and you'll notice this little AutoChartist risk calculator here. This is something that we've put on the chart already, but if you do download this particular program, it's quite easy to install, and you'll be able to have access to this. You'll also notice if we zoom in here on the right, there's two lines. So you've got a green line and you've got an orange line. If I move that orange line up and down, the volume is actually changing on the chart. And that volume is based on a cash amount or a risk amount of my account. So if I was placing a trade here right now at this green line and I want to risk $80 per trade, I could actually have that in here, and it would say that if my stop loss was at this level, it would be a volume of 0.16 that I could trade if I was placing the trade right now in the market or at this green line. That's helpful in a lot of ways. It helps us visualize where the stop loss is, which is a big problem in MetaTrader 4 if we're just using the standard window. So when you're using this and you've got your stop loss and take profit, it's not as simple. The other thing is that it helps us to potentially figure out exactly what we think we're going to kind of maybe get from the trade. So when we can see it visually on here, let's say we were selling here and we thought we could take profit down at this zone down here, you can see that already, because of where our stop loss is going to be, it's very visual that this distance is more than this distance. So if we were risking $80 with the chance of the take profit going down to this level, it would be very visual for us to see that. You can also select things like risk percentage of equity and risk percentage of balance. So we can select our percentages. Let's say we want to risk 1%, and again, it will work out our volume that's needed. Another great thing to do with the MetaTrader tool here is that we can also have expected trading ranges. So if we click this, what you'll notice is a series of different lines comes up. And these are actually lines that are calculated to a 75% accuracy based on previous history through the AutoChartist risk calculator. And what it's saying is that in the next 4 hours, price should remain within these two lines. So basically, price should not move outside of these two lines at a 75% accuracy based on previous history. And that allows us to maybe place our stop loss when we don't know exactly where we want to put it. So in this case, let's say we wanted to be behind the 4-hour volatility amount here. We can just place our stop loss line up here, little bit extra, always good to do. We can see that price in the market is also around here, which is very, very good. And then we can see that we'll be able to place a 0.19 contract. So then we can open up our trading tool, type in 0.19, and we can either choose to place the stop loss based on what the numbers are here. So we can just type this in, so 0.76507. And we can collect, let's say in this case we want to sell by market, so we're going to do that. You can see now it's entered this particular position into the market. You can see us entering into it. The trade is there. If we move this yellow line, our stop loss is there as well. So a very visual way for us to see that trade, and it's excellent because we can select risk percentage of balance, risk percentage of equity, and also just a cash amount if that's what we want to select. You can do this on all time frames as well. I have been asked a few times, what about the 1 hour chart? What about the 15-minute chart? If we change the time frame, it will be able to give us the volatility for that time frame. So let's jump back into the slides for a second and talk about some rules that we always need to have when we're placing trades. Tyrone?
So the number one rule for placing stop losses is once that you have made that decision, whether you're using a market stop or one of the volatility stops that we've just discussed, the important thing to remember is once you've risked a certain amount of a percentage, you can never move it further out. And a lot of people find themselves actually moving their stop loss away from where they've entered if price gets too close because they feel that potentially the market could turn around or it just needs a little bit more room. And it is actually one of the biggest mistakes that you can make, and it's a very, very bad habit for a lot of traders who are first starting up, that the stop losses are moving. Now, there's only one way the stop loss can move by our rules, and that's actually in your favor. So by all means, if the trade does go in your favor, you can move your stop loss closer to actually reduce the risk that you've initially taken, but never, ever take it out. Unless, of course, you've made a mistake on a contract. But for all intents and purposes, that's very difficult to do when you're using some of these tools, because realistically, if you put your stop loss level, like Thomas said, with the visuals, you get a very good understanding of where your stop loss needs to be without having to guess and then move it after the trade has been placed.
Another thing is that rule 2, once you identify a correct take profit level, it's really important that you never take your profit early unless there is a technical reason to do so. And the reason we really stick to this is you need to treat your trading like a business. And as Tyrone said, that's a very, very important aspect of all trading. So how else can we place trades? Obviously, we can use something like that visual identifier that's based on volatility. And then, of course, we can do what a lot of people do, which is use our technical analysis approach. Now, many people out there are going to use indicators. You can have pattern analysis, things like swing trading, all sorts of different methods, and many of them do work. What I want to do is focus on a particular pattern that we're looking at in the market right now, and then use a different tool that Pepperstone have called the Smarter Trading Tools to actually place a trade in the market using that pattern analysis and then risking the correct amount based on the technicals as well. So before we get started, I just want to talk about a double bottom pattern, or at least something where the market is range bound and it's breaking out of that range. So if we are going to place a trade based on a double bottom pattern, we're going to take it when it breaks the previous intervening trough, as you can see here, and we're going to purchase it at this level. Then what we can do is, using a method like this, we would take the distance from the bottoms or the troughs to the intervening level, and we call that, let's say, A. We'd then place our stop just below the low, and in terms of where we place our take profit, it would be the same distance as that A distance we've got here.
So this is a really good example as to why you should never take your profits early, because in this instance, a double bottom pattern is basically a one-to-one trade. So your stop loss amount is going to be the equivalent of what you expect to get out of the take profit if it gets there. Now, if you start messing around with your take profit levels and start taking profits early, it stands to reason that you're going to lose more than you win every time it's a 50-50 trade. So, for instance, if you're risking 100 pips and your take profit's 100 pips, but you keep taking it every time it gets to 50, I can almost guarantee you that every time the trade goes against you, you're going to let the stop loss hit every single time, and it's a big mistake that people make by taking their profits early, because it completely disrupts what actually is in essence a really, really good pattern.
So basically A equals B. And a lot of patterns are like this. You'll always be able to take or know kind of where your take profit should be based on your pattern analysis. Other trading methods also have very similar styles where you have a fair idea where your take profit should be when you're placing the trade. So let's just jump straight back into the charts and let's take a look at another trade that could potentially be in the markets right now. Specifically, we're going to look at the pound weekly chart. So one thing I've noticed about this pound weekly chart when I was discussing with Tyrone is that there is a very strong trend line here on the pound US dollar weekly. But when we break that down into the smaller time frames and we use a line chart, what we will see is that on a 4-hour, the market's been quite range bound in this pullback, and now it has broken through and it's coming back down and testing this level. So by things like a double bottom or even a channel strategy, this could be potentially a zone where we'd be interested in purchasing in this market. But of course, we've got to do that with the correct risk rate. And that's where we can use something like the Pepperstone mini trade terminal to potentially have a couple of different methods of placing this risk rate. So if we open up the mini trade terminal here, left click and drag it onto the charts and then press OK, you'll notice it loads up in this little window up here. Now, one thing a lot of people don't know is this little yellow box, I guess, is the secret behind why this is such a good indicator or a good thing to use. So if we click that little box, it loads up a new window with a whole bunch of different information in it. Now, I do know that Pepperstone, if you, after this session, actually contact whoever looks after your account at Pepperstone, if you talk to one of your account managers, they should be able to hopefully provide you with this tool. So just mention FX Evolution or mention the fact that you did this Learn It Live session, and they should be able to help you out with activating this tool onto your account. So here you can see there's a whole bunch of different types of buys or sells or different orders that we can place. So let's say we just want to buy in the market right now because we're seeing the correct setup form. We can select buy. We can then select a whole bunch of different types of risk rates. So again, we've got fixed cash risk rate, we've got percentage of equity, and we've got percentage of balance. So in this case, I want to use percentage of balance, and I want to trade 1% of our account in this case. So if we want to place a correct stop loss, what we need to do is we probably need to realistically place our stop loss somewhere down here at around 130. And that's because that was the last main swing. Now it may seem like a huge stop loss, but we're just going to be very conservative with this particular trade. We don't always have to be that conservative, but we will in this trade. So you can see here that in this case it'd be about 230 pips. So we'll place stop loss, we'll select pips, and we'll put 230 down. Then what we can do is, because A equals B, we're going to take the distance of this particular trade, work that out, and then from this we can say, okay, this take profit is going to be around 230 pips as well. So we'll place our take profit 230 pips. We can also activate things like trailing stops and stuff at this point if we want to. In this case, I'm not going to do that because we have another way of scaling in and out of our trades later on, but we can do so. Another thing we can do is we can save this as a template. So if this is a particular type of trade that we're going to do quite often, we may want to save this particular order window, or if we have a fixed risk per trade where we're just always risking $100 or something like that, we can save that as an actual template as well. So let's place the order together. And you'll notice that it's placed the buy, it's put our stop loss in, and it's put our take profit in. And I really like the fact that it makes it so clear for us with on the charts, even more so than the standard MetaTrader 4 platform does.
So by activating the Smart Tools Mini Trade Terminal, not only do you get your risk amount right from the get-go, but also your stop loss levels are very, very clear to see. Now, if we were using the stop loss levels on this channel, because we're effectively trading a channel here, it's basically a one-to-one trade. So that's why we've got our take profit of 230 pips. But there are going to be other patterns that we can basically trade that have 2-to-1 or potentially 3-to-1 payoffs. So that's why it's important to actually use the pattern recognition and use the correct stop loss and take profit, I guess, areas for each pattern, because some of them do warrant bigger take profits. If we're looking at this channel on the pound, it's basically between 130 and 133, which has been in play for close to 2 or 3 months now. So it's a pretty significant channel. And the break that we've just talked about here, it's basically a break of that channel plus a trend line that's also trending up quite heavily. So we're going to be looking at another tool shortly using the Smart Trend Line, which will basically give us the opportunity to take a different approach to placing a stop loss if we weren't trading a particular channel pattern. Because the one thing about trend lines is they're a dynamic support. So that means that their aggressiveness is really determined by how the market is moving. So if the market is moving in a very heavy trend, the steepness of the trend line is going to be determined by that trend. Hence why the stop loss is going to change. So it's not as easy to predict, but the smart tools will help us place the stop loss in the correct area no matter what the angle is.
Another thing that I guess we can mention is, let's say we were looking, and a lot of you guys are going to probably be trading the smaller time frames. We do get asked about those. If we were trading, let's say, the pound on a smaller time frame, let's go with 15 minutes. What you will notice is when Tyrone was talking about that dynamic support, there's a very heavy trend line just across here as well, which is now just broken or just about to break if you take it from there. So this is a very key point where we can make a decision again whether we're interested in potentially buying this trade or waiting and seeing what happens if the trend line does break or this point picks up and then of course it moves up here. The reason I want to bring up a 15-minute chart is because this is where you could potentially be just trading a very small contract. So like that coffee cup and muffin approach, $5 or something like that. So if we were placing a trade here and we believed that our stop loss only had to be behind the last swing, so let's say down here or even on this trend line, we could then open up our chart, press buy again, because that's what we'd be looking at, let's say here, and we can select percentage of equity or fixed cash. So in this case, we'll just select $10. We'll place our stop loss in pips. In this case, it needs to be around 25 pips. And we'll put our take profit to go all the way to the top. So our take profit there can just be around 65 pips. So very good risk reward type of strategy. So we'll put pips, 65 pips. Place that order, and you'll notice it's placed it with the correct contract size. You can also go over just to make sure, and you'll see here the profit if we were, or in this case, if we were to take the stop loss, we would only lose $10. So this is very unique to the Forex market. In the stock market, in other commodities markets, even other futures markets, it's even Bitcoin in many ways, and these cryptocurrencies, it can be more expensive actually to trade in and out of those particular tools and instruments, and you can't really learn there. I mean, if you're wanting to trade stock, it would be like $30 potentially a trade, and that is very expensive when you're starting to learn and want to get active in the market. And as Tyrone said before, trading a demo account doesn't make you accountable. So trading something like a $5 per risk or $10 per risk, it makes it more real, and you will have a lot more long-term success if you create a strategy based on this, because as I said, many people start in demos, they have success in demos, they go live and they don't have as much success. So I actually have the approach of, I suggest you have an open account and then you have a smaller amount of money in that account, and then of course you trade with small balances, and you get your confidence up, and then you build up your particular trading balance as you get confident.
So confidence is the key word there, because trading really is about confidence and understanding the market that you're basically trying to work with. So once you do get confident in the trade setup that you're placing and you do have some success, when you are live and you are trading, even if it's only small amounts, it will give you the confidence to move forward because you know you're in a real market, it's real money. And now, as you can see, even with the small trade that we placed earlier on the Aussie, we're already up tomorrow's coffee and muffin, to put it in Thomas's words. So,
and I like coffee.
And and the thing is, we can apply that to a real value. What a lot of people do with demos is they very rarely trade a demo account that actually is going to be realistic to the live account that they're going to trade. So automatically they think that their trading has to change the minute they do go live. So I've very rarely seen demo accounts open that are a $500 balance or $1,000. Most people are going in at 100,000 or potentially sometimes $1 million. But it's giving you a very false, I guess, sense of security when you're placing trades with money that's not really there. And I think you know, deep down you actually know that, and that's why it's really, really important to place these smaller trades because it will set you up as your account gets bigger.
Well, actually, I think my first trade ever on a demo was, I opened the $100,000 account, as you do, and I traded Mexican peso. I didn't know what it was. That was many years ago now, but the point is that it is very common for people to do that. They open accounts, and they usually open way too high for their own balances, and that gives you in. You're actually doing yourself a massive disservice doing that. I can't stress it enough. All right, so let's talk about scaling in and out of orders because that's probably the one thing that a lot of people don't do. So we use a thing called a dynamic stop loss level to do this. So let's go back over to the slides and discuss dynamic stop losses. So if we have a particular trending market similar to what we just saw then on the pound US dollar, you'll notice that often in these markets the trend line is respected, but at the same time you're seeing a series of very similar kind of peaks with a trend line above it. And some people will be probably saying that's like a channel or dynamic channel. It is. But at the same time, we can say track our stop loss level based on what we're seeing here. So if we're seeing something like this happening in the market, why not let our trade have the best chance to make as much money as possible? And of course, when we're in trend, what do they say about trend, Tyrone?
Trend is your friend.
Trend is definitely your friend. And that comes from just the fact that the fundamentals of the market, if they're doing something like an interest rate change or something like that in the market, just remember one interest rate change may lead to more, so therefore the trend may continue in that direction due to that change in fundamentals. And we're not trading fundamentals in this case, but that does help, and that's why trend is very much your friend.
And just on that, the thing with trend lines as well is that when you are in a solid established trend line, as you can basically see here, the strength of that trend is basically determined by the market momentum. So it stands to reason that every pullback or trough, if you like, that's touching the trend line, as long as it's making a higher peak every time it comes back down and touches it, there's no real reason to think that it's actually going to stop. Because there is no rules in place to say how long a trend line can last. In fact, the 2 steps forward, 1 step back approach, which is what a healthy trend looks like, can actually go on indefinitely for months and months on end on some time frames. So the US stock market's a very good example. It hasn't stopped since the GFC. So yeah. The thing is, it's no point trying to preempt when a trend line may end. So we always firmly believe that you trade the trend line in the trend direction until we've given a signal that it's actually not there anymore. And the first signal that you're going to get that a trend line may break down is when it starts to make lower peaks and come back and touches the trend line. So as we can see in this example, we've got higher peaks every time it comes back and touches it. But the minute that starts to make lower peaks and still comes back and touches the trend line, then you're going to have to be a little bit mindful that there's more than likely a weakness in this momentum, and the likelihood of this continuing its support is probably going to be, diminished in the future. Hence why it's a dynamic support level.
And we all like more profits, right, Tyrone?
We love profits. We love it.
All right, so let's go back to the pound US dollar and discuss this dynamic trend line theory. So what we've got here is, again, we're on this 15-minute chart. We've got our trend line. We're pretty confident, let's say, this trade here. But we may want to potentially move our stop loss up over time. So what you can do using the mini trade terminals, you can actually load a line in to the chart. I like to put it just behind where we think our trend line is, just to give us a little bit of safety. And then we can actually Alt left click, and you'll notice it brings up this handy little window. and I don't think many people know about this one. So you've got all these different types of tickets. You can see here we've got a buy stop, and that ticket is this one here. We can double check that with the ticket down here, which is 7.2. We will select the other one. So we want 898. So we're going to select that. And then what we can do is we select stop loss, and we can change part of our order. So we can either select this line to close 100% of our order, or to close a lot size percentage, or to close a percentage of our order overall. So we can actually say we want to change, get rid of 60% of our order if this trend line is hit. Press save, and you'll notice instantly that line goes yellow. And when it does this, it'll also have like a close 60% on it. And that's really good because it means that we've now got a dynamic stop loss level. Now, I may have made it a little bit tight, but that's what you can do. Then what we can do is we can add a few of these lines. So let's say we want to close another percentage of it if it came even further down. So it came like, this line here. We can again click on it. Again, we can select the ticket. And then we can select the other 40% to close, stop loss, 40%. Save. And you'll see there that we've got now the close 40% and close 60%. So if the line, let's say the price moved up in the market, it went higher. So it went higher up here. And then it came back and it hit our stop somewhere up here on our trend line. That would close 60% of the order. And you can see by me moving the stop loss up, it just closed off. And then if it kept coming down, it would close the other 40% here. So it really does follow the trend as long as it's in play.
Yeah, and the good thing about that is, although it's not technically called a trailing stop, it is in fact a trailing stop if the market continues to rise, because being a dynamic level, obviously the steepness of the line is going to follow the trend up. So these tools, by the way, are just, you know, amazing considering what we started with. When Thomas and I first started trading nearly 10 years ago, we could have only dreamt about tools like this to make our trading easy, to be honest. So the fact that you can actually stop on a trend line like this and have the visual, I think that's probably the key to this, like actually having the ability to see what price would have to do to actually close you out. Because if you look at that yellow line, for instance, the second one that we've drawn there, if price happens to get back down there, we can see very clearly that we wouldn't want to be in this trade anymore because the trend has clearly turned around. So that's that visual level is giving us something that we never had previous to these special fandangly tools, where we can actually visualize what we're seeing rather than just putting in a number and hoping that it's in the right level. Because once you do that, that's when you start adjusting your risk, because you think, oh, maybe it's a little bit too far, or maybe it's a little bit too close. So these tools give you the ability to locate the correct stop loss fairly quickly and with a degree of accuracy.
And more importantly, it lets you stick to rule 2. And rule 2 is don't change your take profit levels. This isn't changing your take profit level because this is part of your plan and part of your business, effectively. So when you've got these in, you aren't changing your stop loss, and we can use these again for the take profits. So if we're seeing a similar kind of thing as to this, where price is pretty consistently reaching these highs, what we can do is we can say, okay, this is our line, and we want to close some of the trade at these levels. So let's left click here. Again, it opens it up. We want to, in this case, select our ticket. We're going to select this ticket, 96. 96 is our other pound buy. That's good. And then we're going to put a take profit, and we'd like to take, let's say, 100% if it reaches this high side here. So we can then save that, goes yellow again, and you'll notice the 100%. And that's market dynamic. So that'll move with the market, and therefore it may increase our take profits, and therefore increase our risk to reward ratios. And if we're increasing that, then it means we don't have to be, well, number one, we make more money, but we also don't need to be as accurate with our trades. If we were getting a 50% win, 50% loss, but when we win, we're winning a 2-to-1 ratio. So let's say we're risking $100, we're making $200 for every $100 loss. We're actually doing very well in the market, and we'd be very happy with our trading, wouldn't we, Tyrone?
Well, in that instance, you can have a system that loses more than it wins and still be well in front, at the end of each month. And that's the key, really, to isolate those trades that are going to give you a risk-reward ratio that allows you the ability to have a few failed trades but still be in the game. Not only does that keep your confidence up, but it also gives the market a chance to do its thing, because that's what the market's going to do anyway. We have to work within its boundaries.
So let's just jump back into the slides again, just go over a couple of the concepts we covered today. So we also want to talk about how to increase our take profit percentages. So similar to that line we just drew, we want to spot things like the most likely point of the next support resistance. We want to use dynamic potential take profits if we notice a trend line. And we want to have potentially multiple take profit points. So we can use the dynamic take profit, maybe for 20 or 30% of our order if we want to leave some on, and then maybe use a support or resistance level for taking part of that profit. So we'll look at the Australian dollar trade we had before, and we'll apply that concept to it and see if we can potentially increase our profits by just using a simple strategy like that.
So although we're not talking a lot about support and resistance today, those lines that we were looking at that are basically trend lines do act as support and resistance lines as well. So for those of you who have done our support and resistance webinars previously, feel free to use those as your take profit and stop loss levels, because they are also a very good visual. You just have to make them basically horizontal, so they work in both directions.
So again, the dynamic stop loss levels in a downtrend just kind of looks like this, very similar to what we're going to look at in the Australian US dollar, and it's quite a simple concept. So we'd have our stop loss hopefully just above those that trend line there, and we would use something like the smarter trading tools and that dynamic line to place our stop losses at this point.
Just touching on that, can we just go back to that slide there? Yes, this one here. What a lot of people make the mistake of doing in a downtrend line is actually placing the line underneath price. You must be mindful that in a downtrend, the trend line has to be above price, because it's actually acting as resistance, not support. So a lot of people, I've seen a lot of people do this in the people who we've coached, where they initially put their trend line sloping down but actually below. So that's not what we're looking for at all, because we're not looking for buying opportunities in a downtrend. We're only looking to short at every resistance zone. So just be mindful that in resistance, it's always above price.
Yeah, it's a good point. A lot of people just draw lines everywhere, and I've seen it on quite a few forums and other places where you look at someone's chart, it looks like kind of like a bomb hit it in terms of there's so many lines everywhere, and unless you were a rocket scientist, you couldn't actually understand it. And that really comes back to the keep it simple, stupid kind of principle. You really do need to keep your charts as simple as possible, because simple does work. You don't need to have 5,000 lines on your chart. You just need to have quality lines that other people see. And the more people that see it, the more likely it actually is to occur. Because there is a lot of herd mentality, but what you really want is you want the bigger traders to see it, so they place those bigger orders in the market, and that's what you want.
People are often afraid to trade with the herd, and I know a lot of people say, you shouldn't trade with the herd because they're going to get it wrong, but in reality, you want to be with the herd if you want the market momentum to be in your favor. What we advocate is actually trading with the herd as long as you've got a reason to do so. Don't trade with the herd just for the hell of it. Just be sure that you've got a reason that is sound, and if the herd is in your direction, it's all the better.
So let's now take a look at that Australian US dollar trade and put a few things together and use some of this dynamic support and dynamic resistance potentially to organize our take profiting. So we'll jump into the Australian dollar. You'll notice here, of course, we have our sell that we placed in before using our auto charts risk calculator. So we'll load up a new chart. We'll go just load up our template here. And what we'll do is we'll put on the mini terminal. And we'll go over to a 4-hour chart for the time being. So one thing I've noticed here, and we're discussing it before with Tyrone, is that we don't have a very strong trend line here or anything, but we do have a line that we can approach, and we also do have a line that we can approach from more of the take profit side of things. So when we've got it up like this, you can see that we could potentially use the dynamic stop loss and dynamic take profit. In particular, the dynamic take profit could be very effective. So if we were getting into this trade, let's say that part of our take profit, or we wanted to take part of our take profit at a support level like here. So we can draw in our line, we can left click, Alt, select the ticket. In this case, we'll select the sell order, we'll plot it as take profit, and we'll only close, let's say 50%. So we'll do 50% of the position at this point down here. So press save. You can see here it has 50%. But what I want to do is we want to leave some on and take some more profit, because of course as traders we want to make as much as possible and maximize our take profit while also minimizing how many losses we do take in the market. So we left click on this again, select the ticket, select take profit, change the percentage to another 50%, and there we've got now basically a rule in place where if the market gets to this new low, we're going to take 50% of the order off, and then we're going to also leave 50% of the order on the market to take profit on this trend line. And it may get really low. Maybe it comes over here, takes a little while, and we end up getting our profit down here. Well, that'd be excellent if that happened. So we'd be basically maximizing our take profit on half of our order for another 170 pips, and that's a very good risk-reward ratio.
And like we mentioned earlier, there's no telling how long a trend can last. So as much as that might seem a long way away, we saw with the pound channel a little bit earlier that it can last several hundred pips without failing once. So there's every reason to believe that if this trend line is solid from the top and the bottom, the channel may well go all the way down to 73. So it would be, I guess, remiss of us to take all of our profit at the nearest zone when there's so much potential for what the market's actually doing, which is trending down and making a series of lower highs and lower lows.
So again, we can do it with part of the stop loss as well. We can say, okay, this is our fixed stop loss. If that does happen, we're just going to close it all. But what we can do is we can say, okay, well, we're seeing some kind of, a little bit of market telling us that this could be a point with a line. So what we're going to do, we're going to draw another line over the top of it to give it a little bit of slack, a little bit of extra pullback. And we'll bring that down here. Left click, Alt again, bring it up, put in our ticket, select the ticket, make sure it's right, and then always make sure that's right as well. If you have many things, always double check the ticket number with the number down here on the bottom of the order. Put our stop loss, and what we want to do is we want to close 60% if it hits this particular line. And you can build a lot of different strategies around this. I'm just basically selecting different amounts. I like to usually take whatever your current system is, maybe you take about 70 to 80% off at the take profit level that you've always had, and then just try something like this. Try to work it in to maximize your profits. And do something like leave 20% of the order on, and just at the end of the month analyze your trades and see whether it's working for you or not.
It's really good practice to use these tools even if you know where your stop losses and take profits are going to be, because what it's doing is basically bringing you in tune with what the market's actually doing. So straight away you know what the Aussie dollar, for instance, has been doing over the last few days or weeks or months. And by using these tools, it's forcing you to almost do more analysis than you normally would just by going in there and shorting it, because everybody says to short the Aussie dollar at resistance. What this is basically doing is forcing you to take a bigger look at what the charts are actually doing and seeing what could potentially happen with the dynamic support and resistance, which is effectively what these trend lines are.
Last thing I'd like to touch on today before we go to questions. If anyone does have questions, please feel free to ask them at the end of this session. We're going to just use the Pepperstone Smart Trading Tools trade terminal. We'll just load that up on top of this. Actually, we won't load it up on top of this chart. Open a new chart. You can always just drag and drop onto the chart with these tools, by the way. And you'll see here, it brings up kind of like a trade window, and it also has some of our trades in here, and it shows us like an overall position. It's a little bit more advanced to something like the trade terminal down here. So this is a nice little tool that you've got that you can use. You can also set things like alerts and stuff in here. So let's say we wanted to select an alert and do it for the floating profit. We can do that through this tool. We can say if we want an alarm, let's say if profit goes above $100, and then repeat, send email, all of those things, save it, and you'll see there's a little red alarm here. So I'll let you guys play around with this tool and get used to it, but it is another good one that you can use with the mini trade terminal and of course with something like the auto chartist risk calculator, and you bring all these things together and they're going to help you with any of your trading systems.
So that particular terminal is really suited to people who have got multiple screens. So you can have your charts on one, and it's obviously a little bit overwhelming if you're trading on your laptop, but if you've got 2 or 3 screens, which many traders do have on their desktop, it's a really, really good tool to have in the corner, and you can minimize it and customize it a little bit, but it gives you a very good overall picture on what your current risk is. What a lot of traders do fail to understand sometimes is that they may have more trades open than they realize going in one particular direction or another. So they're basically losing their diversity by not really understanding how many trades they've got open. So that particular terminal does give you the opportunity to see at a bird's eye view exactly how many trades you've got open and how they're all tracking.
Okay, well, we'd like to thank you for attending another one of our Learn It Lives, and we'd like to hand it over for a couple of questions if Josh has any right now.
Yep, we've got one here, and it is, where can I get to these smart trader tools?
Yeah, so the smart trader tools, Pepperstone does, they provide them. So I'd recommend that you contact whoever is in charge of looking after your account. And just as again, say you attended the Learn It Live session last night, and I'm sure they'll be able to hopefully help you out with that.
We've also got someone here asking, just to cover again, where, give me one moment. How did you bring up the auto chartist risk calculator?
Yep, so this particular one here, how did I bring that up? So you do need to install the auto chartist risk calculator, and then once you've installed the exe file, what will happen is it'll come up under indicators as auto chartist risk calculator. You can left click and drag and drop that onto the chart, and it should load this particular program.
Cool. And the last one here, someone asked is, you could just please show them again how to get these smart lines for the stop losses, dynamic stop losses.
Yep. Okay. So from the smart line, you just select a normal line, so a draw trending normal line. You can put it anywhere on your chart. So in this case, we'll just add another one here for a smart stop loss. Once you've dropped it on the chart, you can hold down Alt and left click on the actual line, and that will open up the smart lines. It is important you do need the mini trade terminal to be active on your chart, and you can tell that by this top right hand corner up here where it says Pepperstone mini terminal and a little smiley face.
Good, and that seems like that's all for questions.
All right, well, thanks very much, guys, for attending. If anyone does have questions or even things they'd like to cover over, the next Learn It Live sessions, we'd really appreciate your feedback with all of that, and glad that you guys could attend today.
Great. Now, this webinar will be available on the FX Lounge site probably tomorrow. So if you've missed anything from what we've learned today, feel free to just check out that video and rehash it. And again, look at our technical analysis on Tuesday and Thursdays for our market outlook, where we incorporate a lot of the patterns that we've talked about today and others into what the current market's doing. So thanks again for joining us, and we look forward to seeing you soon.
See you guys.
Thank you.